Honda, one of Japan's most iconic automakers, has been hit hard by the Trump administration's renewed push for trade protectionism. The company, known for its reliable vehicles and global reach, is now facing a storm of economic challenges that threaten its bottom line and future growth. With the U.S. imposing steep tariffs on imported vehicles and auto parts, Honda's profits have taken a significant blow. These tariffs have made it more expensive for Honda to bring its cars into the American market, which is one of its largest and most important regions. The company's net profit for April to September 2025 plunged 37% to 311.8 billion yen, about 2.29 billion. This sharp decline is a stark contrast to the steady growth Honda has enjoyed in previous years, and it's sending shockwaves through the industry. Tariffs alone wiped out 164 billion yen from Honda's operating profit in just 6 months, a staggering loss that highlights the direct impact of international trade tensions on the company's financial health. On top of that, volatile currency swings between the Japanese yen and the US dollar have added to Honda's woes, costing the company another 116 billion yen. These fluctuations make it even harder for Honda to plan ahead and protect its earnings. In response, Honda has slashed its full-year profit forecast by a dramatic 64%, bracing for just 300 billion yen in annual profit. This is a sobering adjustment that reflects the seriousness of the challenges ahead. CEO Toshihiro Mibe has publicly warned that if tariffs continue or increase, Honda may be forced to raise prices on its vehicles. For now, the company is absorbing the extra costs, hoping to avoid passing them on to customers and risking a drop in sales. Honda is walking a tightrope, trying to protect its profit margins without alienating loyal customers or losing market share to competitors. Every decision is a delicate balancing act in this uncertain environment. Despite a brief uptick in its stock price following the earnings announcement, the overall financial reality for Honda remains grim. Investors are watching closely, worried about the company's ability to weather the storm. Honda's leadership now faces a tough road ahead, navigating a volatile global market shaped by shifting politics, protectionist policies, and unpredictable economic forces. The next few months will be critical as the company fights to regain its footing and chart a path forward. In response to a new wave of U.S. tariffs targeting imported vehicles and auto parts, automakers are being forced to rethink their entire supply chain strategy. These tariffs, designed to protect American manufacturing, have sent shockwaves through the global automotive industry, prompting companies to make tough decisions about where and how they build their cars. Honda, one of the world's leading car makers, is now overhauling its North American manufacturing operations in a bid to adapt to these rapidly changing trade rules. The company is taking decisive action to ensure its vehicles remain competitive in the U.S. market. Specifically, Honda is shifting production of its popular CR-V model for the U.S. market out of Alliston, Ontario, and relocating it to its plants in Indiana and Ohio. This move is part of a broader effort to localize manufacturing and minimize exposure to cross-border tariffs. By moving production stateside, Honda is shielding itself from the costly tariffs that would otherwise be imposed on Canadian exports. This strategic decision is aimed at keeping prices stable for American consumers and maintaining Honda's competitive edge. Honda's new strategy is clear: build vehicles inside the U.S. tariff wall, even if it means disrupting long-established operations and relationships in Canada. The company is prioritizing flexibility and resilience in the face of unpredictable trade policies. While Honda insists there are no immediate job cuts in Canada, the future of the Alliston plant is now uncertain. Employees are left wondering what the long-term impact will be on their jobs and their community. Anxiety is rising among workers as rumors swirl, and Honda's long-term plans remain unclear. Many fear that further changes could be on the horizon, affecting not just jobs, but the local economy as well. In addition to the CR-V shift, Honda is also moving production of its Civic hatchback from Japan to Indiana. This marks a significant expansion of US-based manufacturing, as the company doubles down on its commitment to American production. These sweeping changes underscore just how quickly trade policy can force global companies to realign their operations. What once took years to plan is now happening in a matter of months, as companies race to adapt. Honda's swift and decisive action highlights the real-world impact of protectionism, not just on corporations, but on workers, communities, and the broader economy. As the company navigates this new landscape, It remains determined to protect its bottom line, even if that means reshaping its international footprint and making difficult choices about where to invest and grow. Honda's production shift was followed by an even bigger blow: the indefinite postponement of its $8.1 billion EV and battery plant in Ontario. This project was central to Canada's plan for a world-class EV supply chain and thousands of high-tech jobs. The delay has left Canada's EV ambitions in limbo, undermining years of government efforts and incentives. Honda's decision pulls the rug out from under Canada's green manufacturing strategy. For Alliston and Ontario, the loss is devastating. Optimism has turned to anxiety. Honda says existing operations will continue, but the future is uncertain. The region now waits, hoping the EV dream isn't lost for good. Honda's leadership blames U.S. tariffs for shifting CR-V production, calling it a straightforward business move. Building inside the U.S. avoids punishing levies and protects profits. The EV project's postponement, however, is tied to slowing North American demand for electric vehicles. High prices, range anxiety, and weak charging infrastructure have cooled consumer interest. With profits under pressure, Honda is now risk-averse, unwilling to bet big on a softening EV market. Tariffs and weak demand combined to force Honda's hand. The timing stung just weeks before Honda denied any plans to scale back in Canada. The sudden reversal eroded trust and exposed the company's vulnerability to global trade shocks. Honda's rapid adaptation shows the immense pressure facing automakers in today's volatile market. As Honda battled tariffs and production shifts, a new chip shortage hit in autumn 2025. The Dutch government's nationalization of Nexperia, a key chip maker, halted shipments from China and triggered a supply crisis. Honda's Celaya, Mexico plant was forced to stop all production, an unprecedented shutdown. Other North American plants also faced disruptions. The company couldn't say when normal operations would resume, highlighting the fragility of global supply chains. Honda now faces a multi-front crisis: tariffs, investment delays, and supply chain chaos. The leadership is scrambling to keep production moving amid mounting uncertainty. Honda's bombshell announcements landed just as Mark Carney became Canada's new Prime Minister. Carney, elected for his financial expertise, was immediately tested by Honda's production shift and EV project delay. The crisis struck at the heart of his promise to protect Canadian industry from U.S. trade pressure. The government appeared blindsided, with the opposition quick to pounce. Now Carney must engage with Honda and U.S. officials to salvage the situation. The stakes are high. This is a defining moment for his leadership and Canada's economic future. The outcome could shape the nation's industrial trajectory for years to come. Amid the turmoil of a rapidly changing global market, Honda's latest sales figures reveal a fascinating split in its business performance. The company is facing a tale of two divisions, each moving in opposite directions. Global car sales for Honda dropped to 1.68 million units, down from 1.78 million the previous year. This decline was especially pronounced in Japan, Asia, and Europe, where economic uncertainty and shifting consumer preferences have taken a toll on demand for new vehicles. While North America managed to post some growth with steady demand for SUVs and trucks, it simply wasn't enough to counteract the losses seen in other regions. The overall picture for Honda's car division remains challenging. The slump in car sales has become a significant drag on Honda's overall financial health, putting pressure on executives to find solutions and adapt to the evolving automotive landscape. In stark contrast, Honda's motorcycle business is experiencing a remarkable boom. Sales soared to a record 10.7 million units, fueled by surging demand in Asia's rapidly growing markets, where motorcycles are often the preferred mode of transportation for millions. Motorcycles have now become a vital profit engine for Honda, generating strong revenues and helping to offset the losses from the struggling car division. This success is a testament to Honda's adaptability and its ability to meet the needs of diverse markets. The booming motorcycle segment provides Honda with a measure of stability and confidence, but it also underscores the urgent need to address the challenges facing its automotive business. The company must innovate and respond quickly to changing consumer trends if it hopes to regain its footing in the car market. Honda's dual identity, struggling car maker on one hand, thriving motorcycle giant on the other, perfectly captures the company's current predicament and the complexity of its global operations. As Honda looks to the future, its ability to balance these two worlds, revitalizing its car division while capitalizing on motorcycle growth, will be crucial in shaping the company's long-term success and stability. Tariffs, production shifts, and postponed investments have cast a shadow over Honda and Canada's auto industry. Alliston workers face an uncertain future as the CR-V's departure leaves a void. Canada's dream of a world-class EV industry is on hold, with Honda's project in limbo. The government must now rebuild confidence and find a new path forward. Honda, meanwhile, is consolidating U.S. production to survive, but at the cost of its international relationships. The company's future hinges on managing multiple crises and adapting to a volatile market. The events of 2025 have reshaped North America's auto landscape, unraveling decades of integration. The road ahead is uncertain, for Honda, for Canada, and for thousands of workers waiting to see what comes next.